What's going on, everybody? I'm back again for another video. I wanted to talk about the CPI that came out. We're going to also look at the S&P 500, and we also have the rate hike coming up tomorrow. Now, earlier in the market today, pre-market, I was seeing a little pump. I get my kids ready for school, help my wife out, get her out the door. Usually it's about 5 o'clock at this time. I looked at my phone and saw pre-market was absolutely pumping. Well, after I get my kids out the door, typically I try to get at least another hour or two of sleep and get my 6 hours or so. Well, upon waking up, the market was totally different. It was not pumping, it was dumping. And in the end, while we do see some better than expected CPI numbers, the Fed is still going to be raising rates. Inflation is still high. And while it's definitely encouraging, definitely reassuring to see that it's not going up more, the market is still far from doing better. But we're going to look at some things here. Don't forget to like, subscribe, hit the notification bell. And first, let's check out CPI. And everything I go over, I will leave down below in some links for you, as well as a link to the free Discord and some links to some free stocks and cryptos. But what are we looking at here? Well, the CPI inflation rate fell faster than expected in November, as did core inflation, which takes out food and energy. And what did we see? Well, the S&P 500 started absolutely rallying, but it did give back a bulk of those gains as investors realized that we're still going to have a Fed meeting tomorrow. And while it's good to see this inflation come down a bit, the Fed is inevitably going to be raising rates still. Now, as for the numbers, the CPI inflation rate eased 0.6% from 7.7% in October, coming in below Wall Street's expectations of 7.3%. The 7.1% annual gain was the lowest in a year. So basically the CPI, or Consumer Price Index, did rise 0.1%, whereas it was expected to be rising 0.3%. Now core CPI rose 0.2% from October, whereas that was expected to be 0.4. So I personally think Wall Street just saw these numbers immediately and wanted to pump a little bit, knowing that this pump won't be sustained. And looking at annual core inflation, we're looking at 6% from 6.3%. However, that is still very high from the Fed's target. Now looking at this paragraph here, the Fed has signaled that it will step down the pace of rate hikes for tomorrow's meeting, with widespread expectations of a half-point rise, 0.50% rise, bringing it to a range of 4.25 to 4.5. Now this article says it's unclear what this November CPI inflation report will do for the Fed. Just look at this reaction. The S&P 500 rose 3% on this good CPI report, or better than expected CPI report, I should say, but then came back down to only a 0.2% gain. Almost all that 3% was taken back. And Wall Street was clearly just taking advantage of this volatility. And this is something that this article mentions that I think is also important to look out for. They say, bottom line, the Fed risk is definitely not off the table. Don't rule out a continued Santa Claus rally for the S&P 500, but beware that it could end abruptly if the next job report in early January shows strong wage gains. We don't want to see strong wage gains. We want to see wage decreases. This is what the Fed wants to see. In my opinion, wages and also housing, the housing market, those two things the Fed is closely watching, in my opinion. And until those things start buckling and taking a turn for the worse, we'll be continuing to drag through this. I think it's better for these things to finally snap and get on with it, because it is inevitable in my opinion. But next up, let's actually look at a couple other things. I want to pull up the S&P 500, show you a couple things to watch out for. And one thing you'll see is we are trying to hold this 400. In my opinion, this is a futile effort. And you'll see that we're in this widening formation, this broadening pattern. And this was ever since last year, December of last year, we have been on this downtrend. It did try to come up and break out of it here, was quickly rejected and pulled back. Its only chance of breaking out again is on some very good news for the Fed. But in the end, the Fed is going to continue to raise rates. I don't think we're at the bottom yet, but we are getting close. That being said, looking at the S&P 500 long term, I think now's a great time to start adding to it. And then I wanted to pull up this article here, and I'll leave this down below for you as well. But it says the Fed is seen slowing rate hikes, likely ending them below 5%. And it brings up something interesting here that I want to pull up. After a labor market report showed consumer prices last month rose at their slowest pace in nearly a year, future contracts that were tied up to the Fed policy rate moved to price in a further downshift next year. So now traders are betting on a 25 basis point or a 0.25% rate hike for each of the Fed's first two meetings in 2023, and then no more, with some chance the last rate hike could come in. I think they meant March instead of May, because this is implying that it's going to be sooner rather than later, so I think these should be switched out. So I believe it means to say with some chance the last hike could come in somewhere around March, because we're looking at January, February, March. And then it goes on to say, either way, that would bring the Fed policy rate to 4.75 to 5% range, lower than some economics expect and markets have been betting. And one thing I wanted to mention here, as we continue to go on, we're going to be comparing inflation over last year, which was very high. And I personally think as we get more towards the spring, when we really started seeing those high numbers, I think our year-over-year comparisons are going to be much easier to handle, meaning we're going to be going against such high inflation numbers previously. But it will take some time as we get towards that, and let's face it, with inflation still where it's at, the Fed will be raising rates for the foreseeable future. In the end, regardless of that, I think we have had a majority of our downturn. That's just my honest opinion, and I think now is one of the best times to be adding to your high conviction long-term plays. But that's it for today, guys. Just want to give you a quick little thing about CPI, my thoughts on the SPY. Thanks so much for watching, guys, and take it easy.